Hello everyone, welcome to Elliott Wave YouTube channel. This is Henry. Today is Wednesday, 27th of April. The time is around 1 a.m. GMT. So for today, we are looking at the chart of Euro Yen, 60 minutes chart here. Um, Now I know that probably some of you do not trade Euro Yen or do not trade Forex and only trade the stocks. But believe it or not, all the asset classes, whether this is Forex, commodities, indices, and so on, they all correlate to one another, right? So knowing the idea of one group can significantly help another asset classes as well, including bonds as well in this case. Okay, so multi-asset analysis is very important to understand sort of the bigger picture. Okay, so let's take a look at the euro yen here. Here we have a 60 minutes chart. We ended this with 1 at 140, right? So you can see in the subdivision partially because this is a 60 minutes chart. So you can see in the wave 5 ended here, and then this wave 5 in the intermediate degree ended with 1 of a higher primary degree. So what that means then is we are currently in the wave 2 pullback, right? We are currently in the wave 2 pullback, and this wave 2 pullback subdivides into a zigzag. You can see in the A, which is the same degree as this 5 here. So this is your intermediate degree with A as a 5 waves. You can see 1 in the minor degree, 2, 3, 4, 5, ending with A. So now I should be looking for a 3-ish rally now to finish this with B in the intermediate degree, and this 3-ish rally can be in the form of a zigzag, a simple ABC 535 structure. Then as long as this rally fails below 140, which is the high on April 21st, we should then continue to extend to the downside again. So the idea here is pretty simple, right? When we see a forecast like this, technically this forecast is giving you the path. It doesn't necessarily give you the exact level where the A should end, where the B should end, where the C should end. So that's a lot of people misunderstand that idea. This idea actually is to give you an idea. Okay, it should rally in 3 waves regardless where the A is going to end. The A could be ending here, the A could be ending here, right? But the idea is it should rally in 3 waves, where usually in the C is going to be equal to the A. So in other words, before you even know where the C is likely to end, you need to know where the you need to know where the A is going to end. You need to see where the B is ending. Then once you clearly see 1, 2, or A, B, and then another high, then at that time you can start measuring what will be the likely target from the C. So for now, this is just giving you a rough sketch on what we can expect, which is a correction of this 5 waves decline. Then once that 3 waves rally is finished, we can then go down. Now another thing that a lot of people also misunderstand is that the correction in fact can take many different forms. So this is what we are proposing, which is APC at 3 waves, but in reality it can, for example, unfold into 7 swing. So it can, for example, just to give you education here, it's not necessarily relevant to the euro yen. So it can be doing ABC 3 swing like this, right? Just to give you an example. So you can do a 3 ways rally like this, but that 3 ways rally is not ending a P right away, but that could only end the W, right? And so it becomes 7 swing after 3 swing, and then it pulls back in the X like this, and then it does another 3 swings up, so becomes 7 swing, 1, 2, 3, 4, 5, 6, 7, right? And even if this is happening with a complex correction, that doesn't necessarily mean the bigger path is wrong, right? The bigger path is very simple. The way you interpret this chart is okay, we see a 5 waves down, so whichever form of a corrective rally it takes, as long as we stay below 140, which is the beginning of these 5 waves, we eventually expect this to go down. Now some people will just simply use retracement, so they just simply do a retracement analysis of this 5 waves down, and they start targeting some of this Fibonacci level here, like 38.2% retracement, for example. 50% is very popular, and you can see in the 50% here it's also exactly at the same level as the previous wave 4. So yeah, it might as well go there when it finishes the entire correction, right? And then as long as we stay below 140, once that correction is over, again we should be expecting more downside, because this one does look like a 5 waves. Now zooming out now to get an idea. Now you want to ask, is this actually bearish or bullish? And a lot of people also very confused about, oh, you said it's bearish but it is bullish and so on, right? Bullish or bearish depends on the time frame, depends on your expectation, short term, medium term, long term, and so on. Now in this case, when we call this as a wave 1, technically, even if we are going to go down, technically, just by knowing the label here, you know this is actually a bullish market, because it is a wave 1 here. So this is this means if this is happening, this is only a correction. It's going to be ending wave 2 with the primary trend going up, right? So that's the way you know whether the primary trend is bullish or bearish, not to be confused by all this short-term movement, but understanding where we are relative to the bigger picture, right? Now zooming out on the weekly time frame over here, let me put down some of the labels. So this is with one here at the 140. That one should be right here. So you notice if this is called with 1, now we got, let's see from the weekly time frame. First of all, you can see from the lows we got back on June 2016. All you see here is a sequence of a higher high and higher low, right? You got this high, but then this high was broken again by the recent high, and you got this low, and this low is a higher low than this. So it's a sequence of higher high and higher low. So that's why it is bullish, like we mentioned before. Knowing this is a wave 1, you know it is bullish. Now when you look at this structure right here, you simply can measure a couple of extension using the Fibonacci. For example, you can clearly see this is a cycle, this is another cycle. So if you just simply measure an extension like this, you can see we have not reached the 100%, right? And then you also got another sequence from this low, secondary low, May 2020 here, and then you got a, the third low here, March 7, March 2022. Okay. Now this low, by the way, this low is the same as the COVID-19 low in all other asset categories. If you look at the indices, for example, this is the same as the March low 2020. Okay. So we got these 3 important pivot low in the euro yen, and there is a high sequence from here using this one, 1, 2, 3, which has not reached the 100%. There is another sequence from the May, starting from the May 2020, which is another high sequence. This is 1, this is 2, and now we have a 3 to the upside. Now again, a simple sort of extension is telling you we have not reached the 100%, which is usually the ideal minimum target when you have a sequence. So what that means then is we should expect more upside eventually, right? More upside, bullish. Now shorter cycle, yes, we can do a pullback, right? We can rally here to correct and then down again. So technically this is your wave A, and then you got a B, and then you got a C. So this one actually started from the March, so this rally is labeled as wave 1, and then you have ABC like this. So it's one thing is when you look at the 1 hour and then you look at the weekly, the outlook totally becomes different. Now the 1 hour looks like, oh, it's going to sell off, it's so bearish, but then when you look at the weekly, even a 50% correction of the March rally is nothing, right? Like it can drop to 50%, 61.8 is still very bullish from the weekly perspective, right? And it can then go up again like this after we finish with 2. Okay, so that is the idea. We are looking for further weakness, let's say in the medium term because of the C leg, but longer term we are bullish the yen, right, the euro yen. And in the near term, very short term, we might see this rally first to correct this 5-inch decline, and then once that 5-inch decline is being corrected, again, it doesn't need to be this big. The rally can be as shallow as it wants, but we're looking for this rally first, and then as long as we stay below 140, expect for the downside to complete a ABC. Now once we see a clear ABC pullback, now you can see the retracement so far is only a little bit below the 23.6. Once you see a clear risk pullback, then we favor more upside. So let's say you use the 38.2 as a guideline, rough guideline. Let's say 38.2% retracement all the way down to 61.8%, let's say. So basically the potential target for this pullback is going to be around 130 to 134. I know it's a big range, but it's just to give you an idea of the potential move to the downside here, right? And once that is completed, we should then continue to go up again. All right, so we do have a 14 days trial. The link is provided in the description if you want to check our service. We also currently run 2-for-1 promotion. Market is very volatile right now, so I think it's if you are not a member yet and this is only for new members, then it is an opportunity to take advantage. Basically, we're gonna be volatile probably in the next 3 months as the Fed, is going to raise the rate. The market now is pricing in 50 basis point increase from the next May meeting, right? May 5th, and then 75 basis point in June, another 50 basis point in July. So the market can get pretty volatile in the next 2 to 3 months. All right. So I'll see you all again next time. Have a nice day, everyone.